Hello, and welcome back, guys. We're going to be taking a look at different tech companies in quick succession. So stay tuned, there's going to be quite a few videos. Starting with Alphabet or Google. And obviously, a lot of people are interested about in tech companies, and I wanted to make dedicated videos about them. And to start off, I wanted to show you a very interesting article that I was taking a look at. And it's claiming that there is a stock, a FANG stock, that is a no-brainer right now for a buy and want to avoid like the plague. Now, of course, we're going to examine both of these and then some. But I wanted to point out to this article because of a very important graph that I really liked over here. It kind of tells us the difference, how much these companies have achieved in comparison to the S&P 500. And you will see here that the S&P 500, for instance, has gained 128%, as you'll see over the last 10 years. And when compared to companies like Netflix or Alphabet or Amazon, Apple, and Meta, for which all of these I'm going to be making videos again very shortly, you will see that most of these companies have achieved like 400%, 700% insane returns. And that's not to say that this is going to necessarily keep happening, because we can never really know what's going to be happening in the future. However, we do know that traders enjoy trading these stocks, and a lot of people actually do hold these stocks for a long time. And so it makes some sense that you could be seeing these kinds of companies keep growing at a fantastic rate in the future. The thing is, we want to be making sure that we're not overpaying for them, because if you overpay, when the company comes down to a point where they may be losing some money, or they may be not making as much profit as before, or there's a stalling growth or something, then they may begin losing a little bit more in terms of the stock price. And if you have started with like 700% increase in the past 10 years to begin with, it may be problematic. So this is why we want to be buying them for cheap. Very important. And this is what we are examining, of course, in this video, like we usually do. And we're going to start with Alphabet, and you will see that Alphabet is currently sitting at about $138. I did make a video when I bought it, and I bought it at $118, and I thought it was a pretty solid bargain. But what about now? Is it still a bargain? Now, if we take a look at the 5-year chart here in R2, remember myinvestorshaven.com, available to all our patrons. If you're interested, there's a link in the description box below the video. But you will see here that there has been a little bit of a decline at some point, and then back to its course, its usual course over here when it's going upwards. And in the past 3 months, it has been climbing for the most part. Again, as you'll see here, of course, there have been some ups and downs. Now, the important thing is how cheap or how expensive the company is. And the first way to evaluate that, it's not the only way, of course, it's the P/E ratio and the price to free cash flow, which is 28 over here, 29, almost and about the same with the price to free cash flow ratio. We kind of want this to converge, being similar. We don't want them to be too far apart, because when net income doesn't translate to free cash flow in a similar manner, there may be issues behind that, or things that we should be knowing about. But the outstanding shares of the company have also been going down, and this is something that we love to see. The company buys back shares. They're using their money, their profit that they have been generating through the years, to buy back shares. And if you're already an owner of Google stock, this means that your stock has pretty much dynamically appreciated, because there's less of it in the open market. That's what this means. And the company doesn't have many liabilities compared to free cash flow. Obviously, they are a money-making machine, right? So they're not really short of cash, frankly. And in terms of the revenue growth, net income growth, that's the 5-year one. Free cash flow growth and total equity growth, again, fantastic values here for the company. You will see pretty much all of these values going upwards again. That's exactly what we want to be seeing out of a company. And the other thing that is really interesting to me is examining the financial statements, which I always do, and you should always do yourselves. Oops, I got logged out for some reason. Let's log in again. Yeah, that's me. I don't know why that happened. Sorry, apologies. Maybe I wasn't using it for a little while. Probably that's why. Okay, so going back to our financial statements, and you will see here that, let me take you to 10 years of display over here. Starting with 60 billion, that's back in 2013, and right now we're sitting at 282 billion, which is fantastic. As you'll see, this is more than 4 times the amount of revenue that they were generating about 10 years ago. Again, pointing to the insane increase that we have seen in the graph, right? And same thing with the net income, 13 billion to 60 billion over here, and at some point they had 76, which is the reason why the stock went down for a little while and gave us an opportunity to buy at a cheaper price. Now, it's important to notice what is happening with earnings per share, because that's the easiest method in regards to seeing how much your stock could have appreciated through the years. Now, of course, this is an art, not really a science, because it doesn't really appreciate as a multiple of that. But earnings per share, what this means is basically how much you are making in terms of net income per unit of stock that you own. And so in this case, back in 2013, it was almost $1. Right now, it's $4.5. So understandably, it makes a ton of sense for the company to be trading at 459% extra, almost, pretty much, than what it was trading back in 2013, right? It makes a ton of sense, and it won't be exactly that, of course, because there are other factors into play. But this is the important thing about investing. In investing, you want to be buying something that generates some income at some point, and then you want it to keep growing and generate even more income, more and more and more. And at some point, you will sell it when it generates more income, surprisingly more in this case. And of course, you're going to be reaping the benefits out of trading the stock. That's the whole concept with stocks. The stocks, at least, that are not paying dividends, as Google is. Google is not paying any dividends at the moment. That is Alphabet, of course. And you'll see here the same thing with the balance sheet. Again, I'm going to take it to a 10-year display that the tool provides as well. And you will see that the total equity has been growing at a tremendous pace as well, similar, 87 billion to 256. Exactly what you like to see. It's a money-making machine, pretty much. And the other thing that I like to see, generally speaking, is the fact that additional paid-in capital here is basically grayed out. It's zero, because the company hasn't been issuing shares. So they haven't been funding themselves through stock, through issuing shares, extra shares, because they don't need to. It's their money. They're making money out of their business. So they don't really need to issue extra new shares to finance themselves. This is good for shareholders because they're not getting diluted, right? Because there are no new shares being created in the open market. And so their stock is actually worth as much as before, if not more, since the company has been making more money. So this is exactly what you want to be seeing out of a company, especially with these kinds of growths, right? Because Alphabet has been growing at a tremendous pace, which we are going to be examining too. And same thing with the 10-year display of our cash flow here. I would say the cash flow statement, that is, taking you to see how net income becomes operating cash flow or operating income over here, from 60 billion, actually starting from almost 13 billion to 60 billion in terms of net income, we saw that earlier. And then that translates to almost from 18 to 91 in terms of operating cash flow. Of course, there's capital expenditures as well, which will take us to a free cash flow of from 11 to 60. This is insane, an insane increase for 10 years. Think about that. 10 years ago, the company was generating 11 billion, now they're generating 60. That's absolutely tremendous. Of course, again, that's not to say that the company will be generating 120 billion in the next 10 years, but it's possible. It's not unlikely. And it's already a pretty high value. And you have to remember, when a company is generating a lot of money, when we're talking about billions, then it's going to be tougher for them to keep generating much more than that. So if you're generating, let's just say, $100 billion, it's going to be tough to generate $200 billion. But if you start with $1 billion, it's much easier to go to $5 billion. There's less friction in these numbers. It's still, don't get me wrong, it's still going to take some effort regardless. But it's not the same amount of effort. And generally speaking, companies that are behemoths, that are making tons of money, it's going to be tougher for them to grow. And at this point, you're seeing a lot of these companies pretty much giving dividends back to shareholders because they're not growing anymore. It's what you see in most companies. Like, for instance, IBM is one of these companies, or Walmart could be one of these that are potentially paying dividends or already paying dividends, as I'm getting some messages in my phone. So, the next thing, the stock evaluation tool, which we're going to be examining, of course, to tell us whether this is a buy right now. And I was talking about the revenue growth earlier, 21%, 9% last year. You can kind of see it in the handy little table here. The company at some point has insane, tremendous, pretty much revenue growth. And the same thing with the free cash flow growth and the net income growth. Again, you'll see here tremendous ones and some declines in the pandemic year, pretty much, which we do know about and gave us an opportunity to buy, as I did, for instance, myself. Now, what are we doing here? This tool here has the ability to give us three types of projections, low, medium, and high. And so for the low expectations, I'm going to be using, the lower value possible that I have in my mind. And of course, all our patrons can try their own values here. So the revenue growth that I'm going to be using for the lowest estimates is going to be, let's just say 6% here. And let's just go with 8 and 10. Now, of course, you could be trying different scenarios again if you are a Patreon. But for the sake of the video, I have to try some values that make sense. The net income margin that the company has been generating, that's the profit margin pretty much after all expenses are deducted, is about 21, 22, 23%, and you can kind of see it again here in the past few years. 22%, 21, 22, 30 at some point, 21, okay, happens, but I'm going to go near 20. So I'm going to go 20, 22, and 24 here, and again see what we're going to be getting out of this. And the free cash flow margins, exactly what we love to see, about 90 to 100%. I typically use 80 for the lowest risk pretty much, and 90 and 100 here. An annual return of 13% is what I like to use. And when I hit calculate, you will notice that our low estimates are sitting at 61 almost, 82 is the medium estimates, and 108 or 109 pretty much is the high estimates, with the current price being at 138. Now, as I've said before in videos in the past, it makes sense to be buying a company of that caliber if it's a little bit more expensive, especially if it was much higher to begin with. So that would make sense. Now, even at 138, it is expensive, but it could make some sense to be buying this for the next decade, for instance. The thing is, when I bought it, it was 118, and I said the same thing. So at some point there has to be, sort of like a cutoff price. Like, what is that cutoff price? Like, I bought it at 118 when it was, again, the high was going to be similar than what it is right now based on these projections. So 138 is always going to be, again, more like an art, not really a science. But typically myself, I would like to get it at a little bit of a cheaper price as I got it back when I got it. It would make more sense for me to be like $10 higher, like 10% higher. Right now it's about 25% higher, 20 to 25% higher, which is a little bit more. But there are some important positive things about the company as well, like the fact that they have amazing margins. This is tremendous, frankly, because margins translate to profit, and you really want fantastic margins. The company keeps growing at a fantastic rate. It came off of the pandemic where, these years were not great. And so there are some very, very positive things. They have no debt, for example. They have been growing at a fantastic pace. And so buying at these levels here is overpaying, but again, you're buying a company that is great. So, you could think it to yourselves and, decide whether it's a good price for you. For me right now, I would probably wait, frankly. So if it was near 120, again, when I bought it at 118, it made more sense. So right now at 138, I think I'm gonna be waiting a little while. If I were to be buying new Google shares, I would probably like to have a drop. But again, it wouldn't be out of the question to be buying at these levels. But do leave a comment below. Let me know if you're buying right now or if you have bought in the past. And I'll see you in the next video, guys. Thanks for watching. Bye-bye.